Ladies and gentlemen, thank you for standing by and welcome to the virtual series Oil and Energy Outlook for 2016 featuring Michael Tran. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. To withdraw your question, press the pound key. Thank you. I would now like to turn the call over to John Skinner.
Hello. Thank you, Victoria. Welcome, everyone, to today's call on oil and energy, featuring Michael Tran from RBC. My name is John Skinner. I'm the VP of Programs for ASFIP this year. I've scheduled this call as part of a series of forecasting calls leading up to the forecast dinner next Wednesday evening. Previous forecasting calls on monetary policy, equities, and fixed income are on our YouTube page. You can find a replay of this one and also those shortly. What affects not only oil, but also all of those forecasts, and in a big way, is geopolitics. So before we get started, I'd like to plug the annual forecasting dinner one more time, because I think it'll be very timely and informative. It'll be next Wednesday evening, that's February the 10th, at the Grand Hyatt in Buckhead. We've got Willis Sparks from the Eurasia Group, who I think is an excellent source of information on geopolitics and their impact on the markets. So again, that's next Wednesday, the 10th, at the Hyatt. Lastly, I'll also mention our lunch event on infrastructure at 103 West on Thursday, February 18th. As infrastructure gains recognition as a distinctive asset class, I think an understanding of the idiosyncrasies of infrastructure securities market will help us all service our clients better. Again, that's Thursday the 18th for lunch at 103 West. We have a pretty full calendar otherwise, so please check our website at asfip.org regularly for updates. All right, so oil and energy. Everyone should have a wealth of information from RBC. That's 4 research papers sent by email from Kathy Ford on Friday afternoon, along with your dial-in instructions. Michael Tran is on the line with us today. RBC hired him in April 2015 as a director to lead the energy strategy effort. He has a wealth of information from a long career in global energy markets prior to RBC, gaining experience at CIBC, UBS, and BP. Frequently quoted in the media and at CIBC, was part of a team voted the most accurate forecaster of WTI prices by Bloomberg. Michael, we can't thank you enough for spending time with us. It's got to be one of the busier periods of your career. We're truly delighted to have you.
Yeah, happy to be here, John.
I'd like to go ahead and get the forecast numbers out of the way, if you don't mind. Our members, we sent a survey to our members, forecast a year-end WTI price of $52. No respondents forecasting a price below $35. Some as high as $96. Obviously, oil forecasts these days are wide-ranging, as recent prices have been volatile. So with that backdrop, let's start with your personal view on the year-end WTI price, and we can work from there.
Sure, of course. Thanks, John. And thanks so much again for having me. I mean, we're expecting WTI prices to average $40 this year and $57 on average for 2017. Now, what's more important here is we're calling 2016 really the year of 2 oil prices. And what I mean by that is we're expecting much weaker prices or very weak prices in the first half of the year, particularly in Q1, and that's really what we're seeing now, extremely weak prices. This will really be followed by a stronger second half of the year. So by Q4, we're expecting prices to average $50 a barrel. So like John, as you mentioned, a pretty wide range. Even for forecasts on average for the year, the ranges within the year are going to be quite wide-ranging. Now, we have moved off the lows that we've seen in January, but we don't think we're headed much higher over the very immediate term yet. And by immediate term, I mean call it the next 6 to 8 weeks or so. I mean, could we push slightly higher to $35 a barrel or slightly higher than that? Yeah, we certainly can, but we can also dip lower to, call it $25 or lower as well. Now, fundamentally speaking, there are not that many bullish variables that I can really point to over the next 6 to 8 weeks that can really propel the market much higher from here. When you look at all the fundamentals, We have Iranian barrels that are coming on to the market, back online as we're currently speaking now, and there's still, of course, concerns about the broader Chinese economy. Now, the bottom line here is that there's still just too much oil out there. I mean, global inventories are extremely bloated right now, and we're currently in the season where demand for crude oil generally wanes a little bit, given that we're in refinery maintenance season. Now, there has been a lot of headline risk out there, especially as it concerns Russia, OPEC, and the potential for coordinated production cuts. So we would expect further volatility, but we would expect prices to take a bit of a breather here over the very near term before they continue the path higher later in the year.
All right, thanks. All right, so on production cuts, you've got the Russians, the Saudis, the rest of OPEC. Who should we watch? What should we watch? And what do you think the odds are of a cut?
Yeah, that's a great question. I mean, we ultimately placed the odds of any sort of coordinated production cut between Russia and the rest of OPEC as quite low in the near term. I mean, that said, the market simply just can't ignore these headlines right now that seem to be creeping onto the Bloomberg and Reuters terminals on a seemingly daily basis. Now, the difficult thing regarding the headlines is really pulling out what's truth and what's really not. Now, we know that there have been a series of headlines over the past 12 to 15 months about potential joint cooperation between the Saudis and the Russians. The Saudis have made it extremely clear that they will not cut production on a unilateral basis. They could be open to production cuts, but they won't do it alone. Now, we know that the Saudis have repeatedly asked the Russians if they would like to cut together. The Russians have repeatedly said no. So what lends some credence to the latest Russian headlines in terms of potential cooperation is that we know that 2 weeks ago there were meetings between the Russian government and its domestic oil producers. Now, out of these meetings, several Russian oil companies suggested that, you know what, it might be worthwhile discussing potential coordination with OPEC. Now, what's most notable here, and when you ask, well, who do you watch, the answer to that question is really Igor Sechin. Igor Sechin was not present at those meetings. Now, this is significant because he is the CEO of Rosneft. Rosneft is by far the biggest domestic Russian oil producing company at about 4 million barrels a day or so. He's also a very close ally of Putin's, and he has been the single largest opponent towards any sort of potential production cuts. So if you're going to watch one thing in Russia, watch the comments of Igor Sechin. You know, until he potentially softens his tone, we remain quite wary of any potential production cuts. But if he does change his tune, we're, of course, all ears there. Now, secondly, of course, last week there were lots of OPEC countries talking about how 6 of them have decided that they need a potential emergency meeting. Now, this, of course, makes for great headlines for journalists, but not much beyond that in terms of substance. Now, there are always at least 6 countries within OPEC who would love to see a production cut, but these are also the countries that can at least afford to cut their own production. Now, we're talking about Nigeria, Venezuela, Iran, Iraq, Ecuador, Algeria. Those countries would love to see any sort of production cut, but they just can't do it alone. I mean, those countries have no money, and they need to produce as much as they can. So unless the Saudis come to the table, it's unlikely that we'll see anything materialize out of those, quote-unquote emergency meetings that Venezuela's trying to string together.
How long would you say these Gulf Coast states could stand low prices?
Well, I mean, when you look at, these Gulf Coast states, so the GCC countries like the Saudis, like the Kuwaitis, like some of those countries, they can withstand low oil prices better than most countries can. I mean, when you look at the Kuwaitis, I mean, generally they have, quite a bit in terms of foreign FX reserves. They also have among the smallest populations out there. So in terms of actually funding social programs, military campaigns, different things like that, it's not as big of a burden versus when you look at countries like Nigeria or Iraq or Iran. You know, one thing that we often get asked is, well, aren't the Saudis or aren't the Nigerians, aren't they the low-cost producer out there? Yeah, I mean, a lot of these OPEC producers can produce barrels at a fairly low marginal cost. But the key question or the key thing to note here is it's not the marginal cost of production that really matters for a lot of these countries. It's the fiscal break-evens because, like I mentioned, so many of these countries rely almost solely on energy prices or energy revenue. So when you look at countries like a Libya, like a Venezuela, like a Nigeria, those countries, the energy really makes up, 60, 70, 80, 90% of total GDP growth. So when oil prices are at $30, $35, you're not balancing your budget. So a lot of these countries do need much higher prices, call it $80+ to really fund their social programs and military campaigns and the such.
Thanks. All right, so we'll talk about Iran just a little bit. Recently had economic sanctions lifted. Can you tell me just, what can you expect from them? How much and how quickly do you think they can get online?
Sure. That's a great question. So just on the topic of OPEC, when we're talking about Iran and how they fit into the total OPEC spectrum, when we look at all the OPEC countries on a year-over-year basis and say, who looks better today than they did last year? And of course, not many of them do given the low price environment. But funny enough, Iran is the only country that potentially looks to be in a better position than they were last year, largely due to sanctions relief and the injection of capital that they've gotten back, roughly $100 billion or $150 billion. Now, in terms of barrels, we expect Iran to bring back an incremental 375 to 500,000 barrels a day. Now, this is very in line with market consensus, but much lower than the numbers that the Iranians themselves have really thrown around. They've suggested that they may be able to bring back as much as 1 million barrels a day upon sanctions relief. Now, we have a very difficult time seeing how this is the case. I mean, when you look around at current Iranian production, half of their production comes from fields that are older than 70 years old. So that's pretty old. I mean, particularly if some of these fields have been choked back or shut in for a period of time over the past several years. I mean, the bottom line here is you just can't teach an old field new tricks. That's what we've written in research reports, and I think that's a pretty good tagline to keep in mind when you think about Iran.
Thanks. All right, so all the news seems to be bearish these days. Market doesn't seem to care about geopolitical risk anymore. But we know that historically any headlines coming out of the Middle East could send prices higher. But that doesn't seem to be the case anymore. What would you say has changed?
Yeah, you're absolutely right, John. We have, of course, had a tumultuous start to the year here. We have 4 active wars in the Middle East. Earlier in January, we saw foreign embassies get torched. Also last month, the Saudi Aramco bus got lit on fire, and the market barely blinked an eye. I mean, when you think about if these things happened, 3 years ago, the market could easily be up, 5, 6, 8%, just purely on the headline. But the market's just simply not pricing in geopolitical risk premium right now, simply because it really just doesn't need to. I mean, there's really no silver bullet to clean up this market right now. We have had supply outpace demand for quite some time now, and that has really led to global inventories that are at all-time highs. So the current excess of global storage is really acting as de facto spare capacity that's really able to weather any sort of short-term supply-side outages. So we would really need to see an acute, a large, and a lengthy supply-side outage before the market can really think about pricing in a risk premium due to geopolitics again.
Yeah, so let's say we were sometime able to get demand to exceed supply. Typically, how long would it take for a price to really normalize? How much inventory do you see out there? How fast is it growing currently? How quickly could it be worked off? Where do you see this kind of evening out in the long term?
Yeah, so when we think about this question, it's really, I mean, if you ask the question another way, it's really, okay, well, where do supply and demand, when do they actually get back into an equilibrium state, right? And I think that returning the market to a longer-term equilibrium is really a two-tiered process. Now, first, as I mentioned, we have much more supply than demand right now. So first, we need to get rid of the daily market oversupply. Now, this has already started to happen. I mean, U.S. production has already started to taper off. We are also seeing it in some other areas as well. We think that this state of daily equilibrium where supply and demand match is reached by Q4 of this year. Now, at that point in time, we think that prices will be able to, as I mentioned at the top of the hour, average about $50 a barrel or so. Now, second, the long road back to full market equilibrium is when global inventories return back to seasonalized normal levels. Now, this is not a scenario that we really see playing out within the next 2 years because inventory levels are just so high right now. But at that point, whenever we get there, we think the long-term equilibrium for prices will be in the $65 to $75 range on average.
All right. So I think many people have been surprised at the resiliency of global production. Despite oil prices at $30 a barrel, production remains fairly strong. When would you see production fall significantly?
Now, yeah, this is a great question. I mean, if you would have told me, call it 18 months ago, that prices would average in the low 30s, for Q1 2016, I would probably have said, well, there's quite a few countries out there that are in financially precarious situations, and I would, of course, be looking at countries like Russia, Venezuela, Nigeria, Brazil. The list just goes on and on and on. But global production, like you said, John, has been much more resilient than many people have expected this year, despite the low prices. Now, production will fall, and it has already, but it will fall more. And when I think about the pace of production coming off, I really categorize the fall in production to two different buckets. Number one, voluntary production cuts, and number two, involuntary production declines. Now, despite the fall in prices, many of these countries that are large producers, like I mentioned, Nigeria, Venezuela, they don't have any money, and their economies are just so dependent on oil that they just can't afford to shut in production. So they'll continue to produce until they can. So they won't curb production on a voluntary basis. Now, the one thing to also keep in mind in terms of why production has been so resilient on a global basis is that there are barriers to exit. And, you often hear barriers to entry, but I'm talking about barriers to actually exiting this production. So, for example, in many old fields, if you shut in production, it may not come back, or it may not snap back to the same pre-shut-in levels. So that's certainly something to consider. Now, for the involuntary production cuts, what I'm talking about here is natural decline rates. Now, this is much more material in the current price environment now than last year or even the year before. Now, we place annual global decline rates at a pace of about 5 to 7%. Now, this means that global production will ultimately fall by 4.5 to 6 million barrels a day every single year unless you bring incremental projects online. Now, we know that given the large capex cuts out there, there really has been a dearth of investments made in this low price environment. So this will take time to play itself out, but the replacement ratio gets pretty steep pretty quick in a world where capex dries up if you have to replace 4.5 to 6 million barrels a day of new production brought online every single year just to stay flat to the previous year. So if we just stretch and extend your question a little bit and we say, well, who do we see actually rolling over production in 2016? Now, of course, the simple answer here is everyone is watching the U.S., and production, as I mentioned, is tapering now. Aggregate shale production has already gone negative on the year. Growth in the Gulf of Mexico production is masking this a little bit, but total U.S. production will continue to drop over the coming months and quarters. Now, this is very much in consensus view. Now, we think that the key spot to watch outside of the U.S. is Russia and the rest of the former Soviet Union. We think it's so key to the point that we're actually calling Russia and the rest of the FSU the biggest swing factor for oil prices this year. Now, some analysts think that that region will really be able to string production along much like it did in 2015, but we just simply don't share that view. We think that production will fall by several 100,000 barrels a day in Russia and the FSU. Now, some people have talked about how the weak ruble will likely continue to work in favor of Russian producers. I mean, it certainly was the case last year, but when you look around, Russia doesn't have much else working for it. I mean, further tax breaks that previously promised by the government on crude exports have been rescinded. Additional capex has been put on the shelf. And if we just take it back to decline rates, as I was mentioning before, I mean, they're pretty steep in some places within Russia. I mean, you look at some of these West Siberian oil fields, and they have decline rates of 10 to 14%. So the bottom line is these decline rates are steep in Russia, and they just never sleep. And without CapEx, it's tough to see Russia pull another rabbit out of the hat like they did last year.
Well, thanks. About OPEC, can you tell me what if do you have any reason that OPEC would come back together and act as a cartel?
Well, I guess the short answer is perhaps not in its historical cartel form. As I alluded to before, I mean, the Saudis have made it extremely clear that they won't cut production alone. And we know that there are not that many other OPEC countries that have the wherewithal to cut production along with them. So Russia and other non-OPEC countries will likely have to get involved if any sort of cut is potentially tabled here. But I mean, let's think about this for a minute. And I wrote about this in one of the publications I put out last week that everyone should have in their inbox. Now, Russia is the Saudis' biggest competitor in the single biggest demand growth region in the world, that being China. Now, this hasn't always been the case. I mean, earlier this decade, China used to own roughly 20% of total Chinese market share. And Russia back then was, call it sub 8%. If you fast forward to present day, both countries are now neck and neck in terms of competition, roughly sharing that first place title, owning about 14% of the Chinese market. So in other words, the Russians have really surged and the Saudis have lagged over the past several years. Now, if we put a few more numbers around this, the Russians have grown exports to China by roughly 550,000 barrels a day over the past 5 years. When you look at the Saudis, they've only grown by 120,000 barrels a day, which is really just good enough for 8th place. And countries like South Sudan, Colombia, and Oman have all placed ahead of the Saudis. I mean, that's a pretty big stat. So when you think about it from that standpoint, how can the Saudis really afford to cut production right now? Because they're really in the middle of a huge market share battle. Now, taking it back to a previous question that you mentioned, John, on Iran, it would be extremely premature for the Saudis or the Russians to potentially talk about cutting production when they don't have a good idea of what the Iranians will bring back to market. So if you talk about a potential production cut too early, Iran brings back on more barrels than what's consensus, the Iranians will just simply eat your lunch. So the short answer here is we're not expecting any production cuts coming from OPEC anytime soon, given that they're all caught in the middle of this massive market share battle.
All right. Now, lastly, I think since so much of the discussion has been around the supply side, perhaps you could talk about a little bit about the demand side, main drivers of demand. Do you see demand slowing, growing? What do you think about demand?
Yeah, of course. Now, the key reason why this conversation has, of course, been really centered around the supply side of the equation is that, I mean, demand certainly matters, but supply is really what's moving the needle right now. I mean, supply got us into this low-price environment, and supply will ultimately have to dig us out of this low-price environment. But when we're thinking about demand growth this year, next year, we're expecting fairly anemic growth numbers. I mean, just about a growth of 1 million barrels a day. Now, when I think about demand, I model each individual country out on an individual country-by-country basis, and I roll that up into two distinct separate regions, the OECD countries and the emerging market countries. Now, we're expecting the OECD to really be flat on a year-over-year basis. I mean, last year was a very strong year. Prices fell, so we saw growth in a lot of places that we haven't seen growth in quite some time. I mean, when you look at Western Europe, we saw growth there. When you looked in OECD Asia, like Korea, we saw growth there. The U.S. obviously really carried demand growth in the OECD last year, but it's off to a fairly slow start this year given the warm winter that we've really had. The OECD also has been on a one-way train downwards in terms of oil demand, not just growth, but notional oil demand ever since the recession. So with fairly unexciting demand growth coming from the OECD, we're really reverting back to the model where virtually all of the demand growth is going to come from the emerging markets. This is really just reversion back to really the years since the recession of 2008, where emerging markets single-handedly carried global oil demand over recent years, and that's a model that we're really reverting back towards.
All right, Victoria, can we open it up for questions from the audience?
Certainly. As a reminder, if you would like to ask a question, simply press star, then the number 1 on your telephone keypad. Again, that is star 1 to ask a question.
And Michael, while we gather some questions, I think I will just ask you to please comment a little bit about China. Just where does it fit into all this?
Yeah, that's of course a very, very important question, just given how, piggybacking off the demand question that was just asked, if emerging markets is going to really drive global oil demand, China has to play a pretty big part of that picture. I mean, when you break it down and you look at the years since the recession, I mean, China made up a huge part, anywhere from a quarter to a third or more of the global demand growth. Now, when we think about China, I mean, we're certainly not raging bulls on China, but we are cautiously optimistic here. I mean, we ultimately think that the macro spillover to impacting physical Chinese oil demand will be quite limited. I mean, talking about the fears of a hard landing in China, you always hear the media talk about that. These fears are not entirely new. I mean, they have been with us for quite some time now. But surely the days in which we've seen China grow at, call it 800 or 900,000 barrels a day on a year-over-year basis, those days are probably now in the rearview mirror. But even in a fairly weak year, China still grows at a clip of 200,000 barrels a day, which is a huge amount of growth by virtually any other standards. So now, when I think about China, despite the frantic fears really resurfacing every few quarters in the headlines, we have really yet to see any sort of weakness on the macro scheme really trickle through to actually impacting actual Chinese oil demand yet. For example, Chinese demand grew at a fairly decent clip last year. Gasoline led that complex. Gasoline demand grew at a very robust 12% on a year-over-year basis last year. Very, very strong numbers. And of course, this comes despite the fears of the sky falling, et cetera, et cetera. Now, one thing I want to be clear on is, if China slows dramatically in terms of their economy and we see GDP growth of 4.5%, 5%, of course that means that Chinese oil demand slows markedly. But what this does not include or consider is this doesn't include China's strategic petroleum reserves, or their SPR. Now, this is an issue that is entirely uncorrelated with the general Chinese economy. It's a national security issue that they take very seriously. China is trying to get to a place where they have 90 days of crude import cover. Now, it's taken us roughly a decade or so to get to 40, 45% of the way there in terms of actually reaching that goal of 90 days of crude import cover. So simply put, we're going to be talking about this Chinese SPR for another 10 years. We know that there were sizable facilities that came on in the second half of last year, and they'll be looking to fill that over the next several months and quarters. To put some further numbers around this, if we look forward, we know that there's at least 70 million barrels of SPR capacity that came on or is coming on this year. And if we put that into simple context, and of course you can't do the math linearly, but if they decide to fill that over the course of a year, that's a pull of an additional 200,000 barrels a day, which is a lot. So just to finish up on this super long answer here is that, a lot of time I go talk to hedge funds investors about Chinese oil demand, and I run into a lot of people who are very bearish China, and they say things like, well, Mike, that we're talking about true Chinese oil demand, and you're talking about SPR, and they're not entirely the same thing. And I would absolutely agree with that they're not the same thing, but I would also argue that in a vastly oversupplied market like the one that we're currently in, any barrel off the market is really a barrel off the market, really regardless if it comes from true demand or if it goes into SPR, because the only time a barrel actually comes out of SPR is when we're in a much tighter, higher priced market.
Fair enough. Thank you. Victoria, do we have any questions?
It looks like there are currently no questions.
No questions. All right. Well, thanks a lot, Michael, for joining us. And I think if everyone on the call could, please respond to a survey Kathy sends out. Just let us know how we're doing. This is kind of a new effort for us to do these calls, and we just want to get some feedback from you on how everything's going. And I hope to see everyone there at the forecasting dinner. So anyway, we'll hope to talk to you guys later. Thanks a lot.
Thank you so much.
Again, thank you for your participation. This concludes today's call. You may now disconnect.